Hello again, everyone. It is about 10 a.m. on Wednesday, August 24th, 2022. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 most important charts, data series, and quantitative models that we use at Asbury Research that I think are going to be the most important to watch and the most influential on upcoming U.S. stock market direction over the next several weeks and potentially through the end of the year. So let's begin. Number 1, market internals. The Asbury 6 has turned negative. Those who have been following me through StockCharts or through other venues on the internet or through our service, Asbury Research, probably heard me talk about the Asbury 6. The Asbury 6 is one of 2 quantitative tactical models that we use to tell us what the real internal condition of the market is. What do I mean by that? The character of the market has changed over the past 5 to 10 years, in my view. It used to be where if you needed to, you could look at the S&P 500 day to day and maybe volume and get a pretty good back of the envelope indication of what the health is of the market from day to day. I think that's gone. You see it in the way the market trades, the way the S&P 500 trades. It's up 100 today, it might be down 100 tomorrow, up 70 overnight, and then down another 100 the next day. Very, very easy to make mistakes because the markets push your buttons now. It's up 100, you have to buy, or if you're short, you have to get out, and then they're down the next day, and before you know it, you're not even thinking anymore, you're just pressing buttons on your computer to move in and out of the market. We built the Asbury 6 probably about 5 years ago to try to combat this or try to work around how the market has changed. So what we did is we back tested every important tactical metric that I used throughout my career. We started to test them together in different groups to see if we can come up with something that kind of tells what your real health is. Kind of like when you go to the doctor's office for your annual physical. The doctor looks at you coming in the room, your hair's combed, nice shirt. He says this guy looks okay, but once you sit him on the table and they take your blood pressure and they take your pulse and they listen to your heart and lungs, your baseline health, in his view, often changes. That's what this tries to do. So we ended up with 6 indicators, only one of which has to do with the S&P 500 itself. We did this on purpose, just the rate of change in the S&P 500. The other 5 are indicators that can't be influenced by the up 100 today and down 100 tomorrow way the market acts oftentimes now. We've got relative performance between stocks and bonds, investor asset flows, corporate bond spreads, trading volume, market breadth, and we paired these together so if 1 or 2 indicators gives you a bad signal, because there's no indicator that's perfect, they all have Achilles heels, most of these indicators are going to keep you on the right side of the market. So the Asbury 6 had been positive since July the 19th. The market moved up quite a bit since then. It has turned negative as of the close yesterday. Just barely negative, but it has turned negative. You can see the dates in these 4 red cells are all very recently, August 19th, August 22nd, and 2 just yesterday on August 23rd. So 4 or more in one direction is necessary to have a directional bias for this indicator, which is tactical. It's made to be sensitive. It's made to move quickly. But right now it has turned negative. You can see down here, here is July 19th on the chart. That was the last time the A6 went to positive, and now the A6 has gone to negative as of August the 23rd. Number 2, the S&P tests and fails at major resistance. This is really what turned the Asbury 6. So on August the 16th was our peak, but for about a week, we were testing this major 3 different levels are all kind of converging together. We had the October 1st low from last year at 42.79. 43.12 is the trend line that's drawn from the January 4th high in pink. And then finally, the orange 200-day moving average here at 43.15. Failed from there, it rolled down. What does that mean? Well, it means that the major trend is still down. And as of the status of the market right now is this move from the June 17th high was a counter trend move within the larger major downtrend. Why? Because it held this resistance. The major downtrend is still intact. The minor uptrend currently will remain valid above 39.74 to 39.46. You can see them here. That's about 4% underneath where the market is trading right now, and it represents the June 28 high and the 50-day moving average in blue here, which is a minor trend proxy. Number 3, investor asset flows are turning negative in QQQ. So what we have here is a chart of the NDX up on top, daily, going back to March. NDX is NASDAQ 100. That's the large cap index, as opposed to the comp, which is a broader index. Underneath, you have the daily total net assets invested in QQQ and their 21-day moving average. Why the 21-day? Because that's our tactical time period here at Asbury Research. That tells tactical for us is where to be within the strategic trend, the larger trend. Strategic for us is 63 days or longer, which is one business quarter. So what you see here, from July the 6th through August the 21st, these assets moved up above their 21-day moving average, meaning that the assets were in monthly expansion. During that time, had a nice move higher in NDX. NDX tends to lead the broad market up and down. But now these last 2 days, August 22nd and August 23rd, it's edging down underneath that 21-day moving average. It looks like an emerging trend of asset contraction. When that happens, that is usually indicative that we're going to see that particular index start to move lower. You could see it here. From April 8th to May 26th of this year, these assets moved underneath their 21-day moving average, and that gave us this decline. It got us out of the way of that decline, frankly. So now we're starting to turn. If this pops back up, obviously the market is trying to buy this dip that we've had off of major resistance. But as of right now, and that's all we can see is right now, I can't tell you what's going to happen a week from now, and no one else can either. But right now, there are assets coming out of the queues. They're coming out of them in a meaningful way. Number 4, volatility is at a tactical decision point. And for volatility, we're going to look at the VIX, the CBOE Volatility Index. And we've got the VIX down here daily, going back to March, and the S&P 500 up top. So the point here is what we have noticed over the past couple of years or more. 24 in the VIX has been a line of demarcation between a tactical buying opportunity in the S&P 500 and a sustainable market decline. So since Jan the 20th, the VIX has been underneath 24. This is this green dashed line that I'm taking my mouse across now. So this move underneath 24, it basically gave us all of this rally. Now we're bumping up against 24 for the past 2 days. We're not through it yet. We're bumping up against it. That tells me this is kind of a balance point for the market, for the S&P 500. If we can hold 24, and of course the Qs go back, assets start to expand in the Qs again, our Asbury 6 goes back to positive, that's going to give me a buying opportunity. But for right now, we're right on the edge here. So watch the VIX over the next week or so. If we get back up above 24 and stay there, that's going to kind of corroborate what the Asbury 6 is telling us today and what the recent asset leaving QQQ is also telling us. So keep an eye on this closely. Above 24 in the VIX, we're going lower. If the VIX can hold 24 and start to roll back down, then we may see a buying opportunity here over the next week. Finally, number 5 is seasonality. Seasonality, to me, is a secondary indicator at best. So sometimes when the market's at a balance point, as it is now, we just tested a major resistance level in the S&P. The Asbury 6 is edged into negative territory. There's money leaving the Qs, and the VIX is at an important balance point at 24. So seasonality tells us we've got a tough 6 weeks ahead of us. August and September here. This is an annual chart of the seasonal monthly pattern in the S&P 500 going back to 1957. And you can see August and September are the fourth and first seasonally weakest months of the year. Again, based on data since 57. The first week of October tends to be a little dicey, and then we get this strong move in the fourth quarter. So seasonality is telling us to be careful here until we get into the fourth quarter, because especially with the market at a balance point now in terms of tactical, this puts another chip on the scale that we may be heading back down for a while. So there you have it, 5 charts, models, and multiple time periods that suggest that this is a really important place to pay attention. And I think what happens coming out of this little space here right underneath the major resistance in the S&P 500 is likely to be the starting point for the next tradable, investable move in the S&P 500 that could very well take us through the end of the year and into the early part of 2023. So thanks for watching. If you like how we approach markets, feel free to visit asburyresearch.com, or you can go to our YouTube channel. It's Asbury Research's channel, and subscribe to our videos there. There are more videos like this available on the YouTube channel. Thanks for listening. Have a great rest of August, and we'll see you at the next one.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.